all welcome to all in the warm house. And I request all just focus on our distinguished panelist on this panel discussion. Thanks to all. And I'm not taking much time to start it. Let's start the conversation because we are just on the delaying part of the event. So I believe we can start the discussion with your permission of the. Thank you. So my first question, what is the biggest change you seen in the startup funding over the last 3 years? That's Ankur, can you just give a light on the same?
See, I think that last few years, investors have started valuing more revenue, more substance than just a future speculations. That's one big change. Second, the state of observability for AI, for startups by AI, has really impacted. So due diligence has become far more easy and strict. And not just that, but while startups are operating, monitoring the startups has also become very strict. So it's not, so seriousness in the entrepreneur is the primary thing I think is expected nowadays, right?
Got it.
And one last thing, which is last 2 years, that technology is not being the mode anymore. So people are now looking at, can you sell? So distribution is what primarily people are looking at, not your ability to build. Anybody can build now.
Got it. Adding to this, how the AI changing the investing space?
See, that's what I'm saying, right? So investors are now very much looking at revenue, and they're looking at distribution as a mode. They're looking at building a technology is not a moat at all, and so fashion like media, right, plays a very important role nowadays. And also, I would say that check size have differentiated now. People are now saying that, okay, I'll give you smaller checks as you keep building the KPIs. So investment is now led with KPIs, not with money can solve all the problem, right? But still there is always a school of people who are focused on in creating a market. So they still keep on creating a bubble, because one of the flip side of the VC network is that they survive on bubble. So that is not going to end. But they've realized that only bubbles are not relevant. So revenues becomes very, very important.
Got it. So Mandeep ji, I'm asking same question from you. What the biggest change you've seen in the last 3 years in the ecosystem of investing?
So I'll say that with my own context. I'm an ex-HSBC's MD and a global contracts head for Tech Mahindra. So that person used to write checks basis, the PowerPoint presentation, liking the idea, liking the founder, couple of interactions, and the money was given to the founders. In my second innings now, where I'm a investor and board member, advisor, M&A advisor, I date the startups. I date for at least 30 days before I write a check. And in that dating period, I will ask them to talk to a VC friend of mine. I will ask them to talk to a prospective customer that I know intimately. I will ask them to talk to a competition and share with me the learnings. So this is just a way of separating the men from the boys in some sense. That 30-day, dating that I do is the change in my style. So coming to how others are looking at it, I think some of the factors have already been talked about in terms of looking at the reality of revenue, not just the potential of the founder basis, that guy being an IIT or an IIM or an MIT graduate for that matter. The question is what you are building actually real? And then if it is real, will it actually sell? Okay, and if it will sell, then at some point in time, will it become profitable? All of that assessment is being done now, as opposed to waiting for the next round and the round after. So that's the kind of change that I would say is happening as we speak.
Got it. Got it. So when you're evaluating the startup, what most factor you are taking care of more weightage?
See, the most important factor is the founder, right? The founder and the quality of the founder or the quality of the founding team is the most important piece in the puzzle. The second, of course, is the idea. How good is the idea? How scalable is the idea? How practical is the idea? What problem is it solving? And a third factor that I look at very closely, which I think is, I'm the only one who says it, the quality of that idea in that founder's hands. If I see a match between the two things is when I'm most tempted to write a check. And just to make an example of this, an MIT graduate wanting to sell to Kirana stores here, building an e-commerce website, I'll be little less inclined as opposed to the same guy if he's done some sciences going into robotics, right? So the match of the idea in that founder's hand is these are the top 2 or 3 that I have. Then of course there is this book which will tell you the market, the scalability, the competition, how tough it is from a regulatory standpoint and all that. So that checklist exists, I think.
Right. So, Hemant, what's the biggest change you've seen in the ecosystem for the last 2-3 years?
First of all, thank you, Sahilji, and thank you, Lalit, for moderating, and thank you for the audience here who is waiting at this time to hear our thoughts. I'm hoping some of the thoughts are relevant. So I will keep it short. So my thing, I will say same money, fewer checks, harder questions. So these are the 3 things, words which I can say this have changed. And particular to my context, I will say that hasn't changed a bit because earlier also I was very, very selective in investing in startups, and a few of them done decently well. But to the audience here, I'll suggest instead of doing all these things, what my fellow colleague is suggesting, because he has experience and expertise to do, is go with some kind of angel networks or co-invest with someone if you're really keen on investing in startup. And just be aware of that risk-reward ratio is quite skewed in startup investing. And the deals in last 3 years, I think in the dollar terms, money may have gone up probably 11-12%, but the deal size in last, year to year has reduced by half. Data is dependent on the startup registered with the government of India. Yeah.
Right. So adding to this, let's say Ankurji said that AI is getting improved every time and helping the evaluating the startup. Like Mandeep ji said that there is governance issue is facing the startups. So what risk you are seeing from that perspective that derail the startups, we can say that, or from the technology side, from the governance side, what risk you are predicting?
I think the governance has become a key thing. So even in the last, if you track the SME IPOs, the SEBI has made it a little tougher. They have penalized the governance lapses even onto the exchanges as well. So the governance has become, the governance is not only not the checkpoint, like the checklist no longer. It is the no valuation driven driving in the metrics. So I think the governance has become a key thing. I will say the AI is it's again then become a little bit of a, if you are evaluating a startup on the base of, so what I have understood that you are asking me that AI is helping you to evaluate the startup, correct?
Yes. And from that, what's the risk? We can see that.
The risk is same as like humans. The AI has developed a little bit. It is developing. AI is improved a lot, and it will improve a lot. But again, it will depend on the human. AI. Everyone will have access to the same AI. Everyone will here have access to the Claude, Gemini, and all. And then again, it becomes to the individual what kind of the metrics you are giving that AI to evaluate. For example, in my own personal context, we are trying to build an AI to select stocks for us. We do derivative trading for a living, and I was talking to my team that everyone in the world will do the same thing. Right. So we have to be a little bit, personalized thing to tell to that AI so that our stock selection is better than others. Then only we'll be able to make money.
Got it. Thank you, Hemant ji. Ankur ji, so what you've seen that what sector is underperform as of now, from the growth perspective, from the other perspective of the economy growth?
See, in India, especially with AI coming in, I segregate the investments in two parts. One is bigger checks and relatively smaller checks. Bigger checks would be 10 million or 5 million, 10 million plus at the startup, and then it's smaller than that. So bigger checks, which India should invest in, but are not happening, is in the infrastructure layer of AI. So whenever a new technology comes, right, the biggest opportunity is in infrastructure. So imagine, data centers, cooling technology, energy, right? So think of AI as an internet. AI is internet, in fact. We just talk about it like, so internet is here. Now whatever is going to run that internet, operate that internet will become very promising sector now. And then second is AI using internet, building a website or application where you make money, which is a full stack business. So now, technology investment. So I think investing in AI technology is something which should not happen. People should shift from that to invest in businesses that are built using AI. So AI, I am building a real estate company using AI. I'm building a fashion company using AI. I'm building a production house using AI. That is where the value is, and people should invest, not the AI technology and AI infrastructure, if there are bigger checks.
Got it. Mandeep ji, what the market shifted from the growth, what they want actually, from the growth to any cost. Generally, founders are seeing that they want growth. What is the cost it be? They need only growth. So what's your perspective on that?
So this growth at any cost actually is a PowerPoint fantasy. When people have projected growth at any cost, in most cases, it has meant that has actually never happened. Or if it has happened, then it has happened that, you acquire a customer at a CAC of 100 rupees and you are selling only worth 50 rupees. How long can you continue with that, right? So growth at any cost should never have been a moat. There was a time in our lives when VC funding became a very, very easily available commodity. I've seen it in front of me. People walked away at 25 crore valuation for just creating a PowerPoint and nothing else. The business was going to start thereafter, right? So that one is gone now. I actually hope that era never comes back. Even if we have more money available, that money is made available to smarter, intelligent, real businesses as opposed to just PowerPoint stories. So for me, that's like the error in the matrix which happened at a point in time. It should not have happened. It won't happen in the future, hopefully again. So to answer your question, has it shifted? Well, it is where it is. It should always have been. That was the error, or that was the era which should have never happened.
Got it. Thank you, Mandeep ji. Hemant ji, what mistake the founder does when we are raising the money?
I think first of all, which I believe that founders, when they chase, raising money shouldn't be the goal. It's just a fuel to the destination. So I meet so many founders when they say, what is your goal? Okay, I'll do Series A in this month, Series B in this, Series C. So that's not a goal according to me. The goal should be business, and the raising money is just a fuel, and the destination is different. Secondly, the founders sometimes value larger checks than a better check. So I'll say a better valuation than a better qualitative investor. So I think the founder should rate this as well. The person who is investing is not going to be a problem when you're running the smooth operations. Better valuation doesn't mean it is going to help the valuation. Secondly, the peak valuation versus right valuation. Sometimes when there is a hype, few months, like 6 months back, there was a hype on AI. It's maybe 1.5 years back, there was hype on a defense. And, the founders chase on a peak valuation, then a right valuation. When you raise money at the peak valuation, then you are sucked into that growth, growth target, which are sometimes not easy to achieve. And then when you look only at the growth, then you sometimes make a mistake. And then then when you have to raise another money, you can't raise on a down round because you have some contractual liabilities and contractual obligations. So I think these are the common mistakes.
Got it. Understand. Only coming on last question from all of three. Describing the one word, what the future of startup funding?
I will say selective.
Okay, Mandeep ji.
One. I think rational and practical.
So I would say that. The future of startup funding is amazing, right? And it's there. It's actually going to grow.
So, what we have learned from all the panelists over here, the today era, in that the future of that investing, that the growth toward the technology, if we see that, and the fundraising, is fuel for the economy, that for the startup. But they have to build the business, that's the future of India. And that's why all the panelists are agree with that, funding is only fuel, that you run business and only do the business, then everything is around that ecosystem. And that helping also by the technology, by the guidance, and do the more and more towards the governance. But the biggest issue, what is our panelists is also facing that. So that I'm thank to all the panelists over here, and most welcome. Thank you.